Why it's a bad idea to put 20% down on a house. You may have heard that it's smart to put 20% down on a house, or even that it's required. But not only is it not required, but it might not even be a good idea. Let's look at a situation that could potentially happen to any homebuyer. You're buying a $400,000 house and you want to put 20% down, which would be $80,000. You have $120,000 in savings. That's potentially enough to cover the down payment plus closing costs. So you want a lower payment, you want to avoid private mortgage insurance or PMI. So you say, I'm going to put 20% down. So let's say, as an example, closing costs are $15,000. So you add that to the $80,000 down payment and you have $95,000 invested in the house. That leaves you with $25,000 cash at the end of the transaction. 3 months later, your car blows up. You finance it with an expensive car loan, which drives up your monthly costs, but you don't want to spend all your remaining cash. But then something even worse happens. You lose your job, and within a few months, you burn through the remaining cash that you had. You tap your 401k, but that's soon gone too. Unfortunately, you end up losing your home after a while, along with the $95,000 you originally invested. Now let's go back to the beginning and imagine you only put 5% down, which would be $20,000 in this case. Your payment's higher because you have a bigger loan balance and you're paying PMI. But at the end of the transaction, you only invested $35,000 up front instead of $95,000. This did two things. First, you retain an extra $60,000 in case of emergencies. And number two, you put more risk on the lender and less on yourself, keeping your funds out of the transaction as much as possible. So not only is 20% down sometimes not a great idea, it can also put you in a real bind. It's usually worth taking that slightly higher payment and paying the PMI to retain that emergency cushion.